If you're earning a paycheck and you've heard of investing, but you're not sure how to go about it or how to start, then this video is for you. Today, I'm going to share the steps I've taken to build a foundation so that my money can work for me and I can build wealth. I researched and started following these principles as soon as I started making money post-college, and over the last 3 years, I've accumulated a net worth of well into my 6 figures. First things first, before you invest any money, you're going to want to set up an emergency fund in a high-yield savings account. A high-yield savings account might have an interest rate of between 3 to 5%, and it generally fluctuates based off of how the Federal Reserve will raise or lower the interest rates. The savings account you might use with your traditional bank, where you keep your checkings account, so I use Bank of America, is very low. Bank of America's savings interest rate is at 0.1%. So for an emergency fund, where you don't know when you're going to need access to these funds, you might as well have this money sitting in an account with as high of an interest rate as possible, so your money doesn't lose value over time because of inflation. Other banks I've heard of that have high yield savings account are SoFi, Barclays, and Capital One, but obviously do your research and make sure that you're choosing one that works for you. The next step is to pay off any debt, and ideally you're doing this as you're saving up for your emergency fund. You want to first and foremost target any high interest debt. That usually is anything above 5 or 6%. If you have credit card debt, you want to pay that off right away. I think the average credit card debt is something around 20%, and that's a very high interest rate that will dig you into a hole very, very quickly. So if you can pay this off, this means that you're getting automatically a 20% return on your money, because otherwise you'd be paying 20% in interest. For any debt that's around 5% or lower, you can consider for yourself if it makes sense for you to pay off aggressively. The average rate of return for the S&P 500 for the last 20 years, so from 2002 to 2022, has been 8.19%. And if you don't know, the S&P 500 is an index that tracks the 500 largest US companies. If you make the minimum payments on a debt with an interest rate of 5%, that leaves you more money to be able to invest in the market. And if you invest in the S&P 500, there's a greater chance that your long-term investing returns, which is roughly 8% per year, will beat out your returns from paying off your debt, which is 5%. The caveat is that the returns on the market aren't guaranteed, but the returns that you get from paying down your debt are definitely guaranteed because you're not having to pay the interest. Depending on how much risk you're willing to incur, you might even consider paying off your debts very aggressively while you're building out your emergency fund a little bit more slowly. So you've set up your emergency fund, you've paid off all of the debts that you want to target, and now we're ready to play. If you work for a company, here are the company benefits you might have. There might be more and there might be less, but you should look into which company benefits your company offers. Lots of companies have a 401k match. First things first, you should max this out as much as you can. I think the most common benefit this looks like is a company matching 50% of any dollar amount you contribute into your 401k up to a certain percent of your income. So with pre-tax and Roth contributions combined, in 2023, you're able to contribute up to $22,500. You may or may not contribute this amount, but you should max out any amount that your company is willing to match, because that's free money. You might have the option to invest in a traditional 401k or a Roth 401k. So in the traditional 401k, you contribute pre-tax money into the 401k, and at 59.5, the age at which you can withdraw from a 401k, you pay taxes on what you withdraw, I think as income. With the Roth 401k, you contribute post-tax money, and you don't have to pay taxes on this when you withdraw at 59.5. Another company benefit you might have is an HSA. This is called a health savings account, and you're able to contribute pre-tax money into an HSA, which you would then use to pay off any medical expenses. I max this out because I'm human, and I would imagine I have to see a doctor at many points in my life. So this is the money I would use to pay for those fees if I have any. The next company benefit you might have is an employee stock purchase plan. This is a program your company might run where you can purchase company stock at a discounted rate, usually up to 15%. You allocate a portion of your after-tax income into purchasing the stock, and each quarter this stock will vest in your brokerage account. If you choose to sell right when the stock vests into your account, then you automatically get a 10 or 15% return on your investment. and that percentage really depends on what the discount is. And of course, you would get taxed, so plan accordingly. You can also choose to hold the stock, and it could grow or decrease in value. And I've heard some pretty solid arguments on why you should sell. If you buy and hold your company stock and you work there, then you're not very diversified. If for whatever reason your company goes bankrupt, you might get laid off, so you no longer have an income, and now your stock, your company stock that you held, is probably worth much less than it used to. But on the other hand, if you truly believe in your company and you believe in your leadership and you hold the stock, you could get a great return on your discounted purchase. The next step is to open a Roth IRA account if you haven't already and contribute the maximum amount that you can. For 2023, the limit is $6,500 that you can contribute to a Roth IRA. And if you're over the age of 50, then the limit is $7,500. I really like the Roth IRA because any money in this account grows completely tax-free until you want to withdraw anytime after the age of 59 and a half. If you're over the income limit, which is $153,000 for 2023 for single filers, or $228,000 for those married filing jointly, then to get the benefits of a Roth IRA, just do a backdoor Roth IRA. A backdoor Roth is when you first put your money in a traditional IRA, and then you roll over that money into a Roth IRA. And I'll link a step-by-step video in the description that I found really helpful around this. After you've done all of the above steps, paid off your debt, set up your emergency fund, invested in your retirement funds, any extra funds you have, you might consider allocating toward a brokerage investing account. I personally use Robinhood and Fidelity. This is money I don't see myself needing to spend over the next few years, but I still have easy access to if I need to liquidate it. Maybe I got laid off and my emergency fund is drying up. Maybe I want to take some time off and travel. Maybe I want to buy a house. Basically, I would have options. I put the bulk of my money in large market ETFs, which are exchange traded funds. An ETF is a basket of commodities because I think it can be more than just stock. The ETFs I mostly look at might track international markets, it might track a variety of different types of domestic indices as well. And I primarily invest in an ETF that tracks the S&P 500, and then I just leave it. If you're making a lot of money, you're comfortable with your cash flow, and you've maxed out all of your various types of accounts that I've already spoken about, you might consider doing a mega backdoor Roth IRA. You have to make sure your company allows it, but for the $22,500 401k contribution limit, some companies allow their employees to contribute an additional amount of after-tax money up to $66,000. This dollar amount will vary because you have to take away the company contribution, but it would basically be $43,500 minus whatever your company contributed to your 401k. From here, you contribute that amount of money, which is the after-tax contributions, and you roll it over into a Roth IRA. And I know this is kind of vague, but different companies have different ways of doing it, so you'd have to check with your company to see if they even have that option if you're interested in doing the mega backdoor Roth IRA. If you like this video, please like and subscribe. And once you're saving and investing as much as you can, you might want to look into how to generate a higher income. Check out this video here where I talk about how to create a side hustle.